Assalamu alaikum. I hope you guys can see my screen. Am I audible? My screen is visible. Please do let me know so that I can start accordingly. Hmm. Am I audible? My screen is visible. Uh, Thank you for the feedback. So, apologies. So, I welcome you all on the day two of this Practice to Pass webinar organized by the ACCA. So, let's start today with our agenda of day two. And I hope you guys can see the agenda of day two on my screen, which is 14th Feb 2022. Uh, well, so let's start. First of all, the discussion part, then we'll move towards the question relating to that. First of all, before I start the discussion of the relevant discussion, I like to make one more discussion. The discussion is around share options. With respect to the share options, there are three things always. One is option grant, one is option exercise, and third one is disposal of shares. Now, share options can be categorized, can be divided into two types. One type of share option is called as approved share option scheme, and another one is called as unapproved share option scheme. Now, what is approved share option scheme? What is unapproved share option scheme? So, approved share option scheme is any share option scheme which is designed, structured in accordance with the rules, regulations guided by the tax authority. Whereas unapproved share option scheme is the one, obviously, which is not in line with the rules, regulations guided by the tax authority. At time of grant of share options, whether approved or unapproved, there are no tax consequences. There are no tax consequences at time of grant of share options. Second, exercise of share options. So at time of exercise, there would be some market value at exercise date. Less exercise price plus cost of option, if any. I deducted the exercise price. Whatever is the differential is called as benefit for me. Whatever is the differential is called as benefit for me. If the share options are, I will rewrite it, okay? If the share options are approved share options, then this benefit is exempt benefit. And if the share options are unapproved, then this benefit is taxable benefit. And since it is a taxable benefit, so you have to pay income tax either at the rate 20, 40, 45%, plus you have to pay NIC as well on it because it relates to your employment income. If the share options are quoted companies, then class 1 NIC would be applicable because the quoted company shares are considered as liquid asset. And if the share options are, if the shares are of unquoted company, then they are not considered as liquid asset, then class 1A NIC would be applicable. After the exercise of shares, the third step is the disposal of shares. Sorry. The third step is about disposal of shares. At time of disposal of shares, what will be the tax consequences? There would be some disposal proceed. Then there will be cost of share options. What constitutes the cost of shares? The cost would consist of exercise price plus cost of option, if any, plus benefit taxed at, like these three things would be some of the cost. As a result, whatever is the difference would be gains. Over these gains, we are supposed to pay capital gains tax either at the rate 10% or 20%. I am supposed to pay capital gains tax either at the rate 10% or 20%. And if BADR conditions are met, if BADR conditions met, then rate of tax would be like what? If I think loudly, what are the major conditions for the BADR? The major conditions for the BADR in respect of share, the holding duration should be more than 2 years. I would be an employee, obviously, that's why I have granted the share option. Employment, more than 5% holding. If these conditions are met, then the gains would gonna tax at the rate 10%. Is this thing clear? Just to share with you before move forward, approved share option schemes are of four types. One is called as CSOP, which is abbreviated as Company Share Option Plan. Another one is called as EMI, which is like abbreviated as Enterprise Management Incentive. Third one is called as Save As You Earn. And fourth one is called as, let me write the abbreviation and we'll call out the full form. Fourth one is called as SIP, which is abbreviated as Share Incentive Plan. Any question till now? I'm looking towards the comments. Any question till now, or am I good to move ahead? So yes, at times it is a frequent feature, like these share option schemes will be examined in the exam. So it's not like irrelevant or out of the box type situation. Okay, considering no more question, I'm heading towards my next discussion, which is about the approved share option scheme. And at the moment, within the approved share option scheme universe, I'm going to pick up uh, two schemes to discuss. One is called as CSOP and another one is called as SIP. CSOP is Company Share Option Plan and SIP is Share Incentive Plan. Okay, so let's start the discussion. Qualifying employees, who like which employees are eligible for the CSOP and SIP? CSOP is restricted to key employees only. So it's up to the organization how they gonna decide the key employees, and whatever is the way to decide key employees, the share options would only be granted to those key employees only. The key employees can be in the form of, for example, designation. They can be in the form of, for example, their employment tenure. It can be in any form. Share incentive plan, it must be open to all. So, share incentive plan cannot be offered to the limited employees. It must be available to all employees. Second, maximum total value at grant per employee. So, how much total value of shares can I grant at max to employees? Under CSOP, the maximum amount which can be granted to employees is options worth 30,000 max. Let me cover up the CSOP first. Other conditions, there should be no discount at grant. There should be no discount at grant. What do you mean by this terminology? No discount at grant. Discount at grant, the concept of discount at grant arises if exercise price is less than market value at time of grant. Such philosophy, such thing is called as, such philosophy, such thing is called as, you are issuing share option at grant. And like I said, there should be no discount at grant. No discount at grant means exercise price should be greater than or equal to market value at grant date. If this thing is met, it means you are not giving any discount at grant. Exercisable more than 3 years and less than 10 years. So it is like a corridor for the tenure of the scheme. The tenure of the scheme is minimum 3 years, maximum 10 years. If owned more than 30% of company, excluded from a scheme. So it is only available to the employees who owns less than 30% of share. Tax treatment at grant, no income tax or NIC. Tax treatment at exercise, no income tax or NIC. Tax treatment at disposal. So if you are going to dispose of the shares held under CSOP, normal capital gain based on proceeds less exercise price plus cost of option, if any. Now, after the CSOP, the next discussion is around share incentive plan. In the share incentive plan, keep one thing remember, employees are awarded with the shares directly, which are like the shares are owned by the employees, but they are not in the custody of employees. The shares are in the custody of the company. Maximum total value at grant per employee. Company can issue free shares up to a maximum of 3,600 per annum. Free shares, like free of cost shares to all of its employees up to 3,600 per annum. Those employees, now, second step. Employees can purchase partnership shares. Employees can purchase partnership shares of maximum 1.1800 per annum and subject to a maximum of 10% of their salary. So just imagine if any person has a salary of, let's say, 15,000 per annum. So 10% of 15,000 is like 1,500. So in such situation, the person can max purchase the partnership shares worth 1,500. Those who purchase partnership shares would get matching shares in the ratio of 2:1. Those employees who purchase partnership shares would get the matching shares in the ratio 2:1. So if, for example, if I had purchased partnership shares worth 1200, hypothetically, so I would get matching shares of worth 2400. Then other conditions: hold for at least 3 years except partnership shares, and 5 years for maximum benefit. So minimum holding should be 3 years, and the maximum, and to get the maximum benefit, the holding should be for 5 years. What is the tax treatment at grant? Once the share options is granted to you, what will be the tax implication? There will be no income tax or NIC on issue of free or matching shares. Partnership shares are purchased out of income. No income tax on dividends used to buy partnership shares. So if you receive the dividends from these free shares and you are reinvesting that dividend income into the purchase of those partnership shares, then there will be no income tax on such dividend income. Tax treatment at exercise. This is the most important and interesting area of this thing. Tax treatment at exercise. If withdrawn in 3 years, so if you withdraw your shares from the company within 3 years, income tax and class 1 NIC is payable based on the market value when withdrawn. So you have to pay income tax and NIC on which value? Based on the market value of shares when withdrawn. If withdrawn after 3 but before 5 years, income tax and class 1 NIC is payable based on lower of market value when first awarded, like when the share options are when the shares are granted, and market value when withdrawn from the share incentive plan. So whatever will be the lower of value would be considered as relevant value for income tax and NIC purpose. If withdrawn after 5 years, there will be no income tax, no NIC implication. So remember, hold for 5 years for maximum benefit. So what is the maximum benefit? The maximum benefit is there would be no NIC, there will be no income tax. Tax treatment at disposal. If you dispose of the shares, then what will be the consequences? If withdrawn after 5 years, there will be no CGT. Remember, maximum benefit. So the maximum benefit, if you hold the SIP shares for like 5 years, there will be no income tax, no NIC, no capital gains tax. But if you withdraw within 5 years and disposing of the shares, then there will be a taxable gain based on proceeds less amount taxable at withdrawal. Whatever is the difference would be your gain figure. On these gains, you are supposed to pay capital gains tax after deducting annual exemption if available, either at the rate 10% or 20%, and if DADR conditions are met, then 10%. Now I am waiting for your response. Is there any question? Is there any question relating to these share options? Um, any question from the discussion of share options, approved, unapproved kind of stuff? Uh, uh, to Kamran, no, like I said, there are in total 4 share option schemes, and I have picked up only these 2 approved share option schemes for the discussion. So yes, there is income tax implication, and there is a capital gains tax implication at time of disposal of share. Okay, let's move ahead towards the next discussion. The next discussion is around the principal private residence stock, PPR, which is part of the capital gains. Okay, principal private residence. What is the principal private residence? At any point of time, an individual can hold one principal private residence. So, like one person can have one principal private residence at one point of time. The gain arising on PPR will be exempt according to the following formula. The formula to calculate the PPR exemption is gain on disposal of the PPR multiplied by period of occupancy, which includes the actual occupancy and deemed occupancy both, divided by the period of ownership. Actual occupancy is like you are actually living in the property. What is deemed occupancy? The deemed occupancy is basically like you are not living in the property, but for tax purposes, it is considered as you are living in the property. Now, in which circumstances tax authorities would consider that you are living in the property? There are four situations where it is considered as you are living in the property. One, up to 3 years. For any reason, if you are not living in the property, you will still be considered as you are living in the property. Up to 4 years for working within UK. So if you are working within UK and you are not living into your main residence, up to 4 years, it would be considered as you are living in the property. Any period for working abroad, so unlimited period if you are working out of country, obviously you will not be living in your main residence. It would be considered as deemed occupied. Last, the final period of ownership of main residence is always treated as period of ownership. This period of exemption is 9 months unconditional. So always the last 9 months before disposal of property would be considered as deemed occupied. The important note is it is compulsory for the individual to occupy his or her residence both before and after the period of absence to claim exemption under first 3 points above. And it should be at least 1 month of occupancy. Keep remember, PPR exemption is available on living in the property. So if you are using your PPR for business purpose as well, for example, you are doing any kind of consultancy from some area of the house, for example, you have 4 rooms in the house, and from one room of the house, you are doing your consultancy business, uh, you have opened up a shop, you are doing any of the business. So PPR is not available on the business use of the property. Then the last discussion within the PPR universe is about the letting relief. Letting relief is only available where a property is let out and the property owner is in shared occupancy with the tenant. So it's like the kind of, you can say, I'm just saying it loudly, a kind of a renter room type of thing where the person is living in the property and let out his property as well. It would not be available if the whole property is let out. Okay. So, for example, if I'm working in other city or other country, and if I have let out my property, then letting relief would not be available. Letting relief is the lowest of the amount of gain which is already exempt under the PPR provisions, i.e. PPR exemption amount, the gain accruing during the letting period, the letting part of the gain, and a fixed constant amount of 40,000. So you can say the letting relief is a maximum of 40,000. So letting relief cannot be more than 40,000 because it is the maximum amount of relief which you will get. Uh, I'm done with the discussion of this PPR stuff. Now I'm looking towards your comments, your questions. Can we rent out the flat in case we are working abroad? When it came to sell the flat, this will be classified as deemed occupied even though rented out. So to steward, yes, like I said, the last 9 months is always considered as deemed occupied. And if you are working other city or other country and your property is let out, you will get the PPR exemption up to its own tenure, like 4 years, uh, any unlimited period, and up to 3 years working in due to any reason you're not living in the property. So you will get the PPR exemption. I hope that would be clear. Uh, any further question relating to this? The PPR exemption thing? By the way, keep one further thing, remember. The PPR exemption, the PPR exemption is automatic. So you are not supposed to claim it from the tax authorities. You will automatically get this PPR exemption. Okay. Considering no further question, let's move ahead to the next discussion. The next discussion is about the gift with reservation, and gift with reservation is part of the IHT, inheritance tax. To Moses, like there is when person is working in other country abroad, there is no maximum tenure. So that is the unlimited period it would be exempt. Okay, let's start the discussion with gift with reservation. The concept of gift with reservation is basically it is a gift where legal ownership of the asset is transferred to the donee or transferee, but the donor or transferor retains some benefits in the gifted asset. So it means effectively you have transferred the risk and rewards, but like you have transferred the asset, but you are retaining some of the risk and rewards relating to the asset. Such thing is called as gift with reservation. If I think loudly, the most common examples of gift with reservation is, for example, a father transferred a property to its son or daughter, but imposing a condition to live in the property, or if the property is let out, the father, for example, is putting a condition to receive the rental income of the property, gift with reservation. Second example could be father transferred a bank account to its son, but the interest income, for example, it is a saving account, the interest income on that bank account will not be transferred. Third example, if the shares are transferred to the son, for example, the right to receive dividend is not transferred. So such instances, such situations are called as gift with reservation. Now, what will be the IHT treatment of the gift with reservation? With respect to the gift with reservation, there are two possibilities. Either the reservation is still in place when the donor dies, or the second possibility is like the reservation is lifted before donor dies. If reservation is still in place when the donor dies, then during lifetime, it is original gift that would be calculated, considered as PET or CLT, which would be calculated according to the concept of diminution in estate at time of transfer. At time of death, asset was in reservation of the donor at that time. So the asset would be added to the estate calculation at probate value as normal. The PET, CLT are ignored then. Like PET, CLT ignored, the asset would be part of the estate of the deceased person. IHT on gift with reservation is the responsibility of donee or giftee. Second situation, where the reservation has been lifted before the death of the donor. Like, for example, father imposed the condition to live in the property, but before that, after some time, probably, father lifted its condition. Okay. So during lifetime, original gift, so at time of transfer, it would be PET CLT calculated according to the concept of diminution in estate at time of transfer. At that time, asset reservation lifted before the death of donor. Whatever was the reservation lifting date would be considered as deemed date of PET CLT. Original PET CLT date would be ignored. So 7 years would be counted from the date the reservation was lifted rather than the original PET CLT date. IHT on gift with reservation is the responsibility of the donee or giftee. Uh, Another important point with respect to the gift with reservation is if donor is paying commercial rent for the use of gift with reservation, for example, like father put a condition to live in the property, but father is paying commercial rent for the property to its son or daughter. Father put a condition to receive the interest income, but after receiving the interest income, father is giving that income to his son. Then, in such situations, it would no longer be considered as gift with reservation. Um, Now, I'm looking towards your questions, if any. And in case of no question, I will be heading towards my question part mainly. So if there is any question, please do let me know with regards to especially the gift with reservation concept. Is there any question relating to this? Okay, how the PET CLT will be ignored. So it is like one. Okay, here basically two things. One, at time of transfer, the transferor imposed a condition, and secondly, before that, the transferor lift up the condition, lift up the reservation. So in such situations, the date when reservation was lifted would be considered as your deemed PET or CLT date, and the original PET CLT would be ignored. So deemed date means that is not actually your transfer date, but for IHT purposes, that would be considered as your PET or CLT date. Okay, since we are done with this discussion and considering no more questions, let's move towards the question part of this. So I'm moving towards the question part of this. I'm opening up my I have already logged into my ACCA CB practice platform. I'm going towards the ATX past and practice exams. And over this practice exams, I'm going to open up the paper which is like ATX June 21. Okay, I'm going to open up the paper June 21. Are you guys with me till here? In case of yes, do let me know so that I can proceed further. To Eteshan, the answer is no, because it is part of the state of the deceased person. So the PET CLT will be ignored. I'm moving towards this. Next. This is like I'm heading towards the question number 4, uh, the section B type question. Once you guys are here with me, please do let me know. Okay, should I start the question? You guys are with me. I'm going to start the question. You should assume that today's date is 1st December 2021. B. The managing director of Y Limited has requested advice on the tax implications of Y Limited setting up a tax advantaged share incentive scheme for its employees. He also requires advice on the capital gains tax reliefs available on the sale of his house and the potential IHT liability arising on the gift of an apartment. The following exhibit available on the left hand side of the screen provide information relevant to the question. Okay, uh, let's look into the exhibit. Y Limited is a UK resident trading company. Fine. Is considering setting up either a company share option plan or a share incentive plan, both of which would be offered to selected employees. Y Limited. Criteria for its tax advantaged share incentive scheme. Employees will be selected to join the scheme dependent on their period of employment with the company. Okay. If the scheme is CSOP, each employee will be offered options to purchase shares worth up to 3,000 each year. Employees will exercise the options 5 years after being granted them. Employees will exercise, okay, if the scheme is a share incentive plan, each employee will be given free shares worth up to 3,000 each year. employees will remove their shares from the plan after 5 years. Okay. D was gifted an apartment by his aunt Jacama on 5th June 2019. He has never lived in his apartment. Okay. Will sell the house he currently lives in and move into this apartment on 31st December 2021. D. Sale of his current house. D purchased his house on 1st July 2013 when he was employed overseas. D did not own any other property between 1st July 13 and 4th June 19. The sale of the house on 31st December 21 will give rise to a chargeable gain of 145,000. So directly I will be getting like I have been given directly the gain amount before any relief. D occupation of his current house. D moved into the house on 1st January 2014 on his return to the UK. D was occupied the house since 1st January 2014 apart from the period from 1st July 15 to 31st December 16 when he was once again employed overseas. D resumed exclusive occupation of the house on 1st January 17. Since 1st April 17, D has let the basement of the house, which comprised 25% of the property for residential use, retaining exclusive occupation of the remaining 75% for himself. Gift of the apartment by Jicama. Okay. When Jicama gifted the apartment to D on 5th June 19, it was on the condition of her continuing to live in the property for the foreseeable future. On 12th March 21, Jicama began living with her sister and she removed the condition she has previously imposed on the gift from that date. Fine. Now, let's look into the requirements. Explain whether or not a company share option scheme and share incentive plan will satisfy Y limited criteria for tax advantaged share incentive scheme. So first you have to comment whether they meet the condition or not and the income tax implications for the employees of acquiring the shares in each case. Each case. Calculate with brief explanations the private residence relief and the letting relief, if any, which are available to reduce the chargeable gain on the sale of his house. Explain the IHT implications of Jicama's gift of the apartment to Decon on 5th June 19 if Jicama were to die in December 2024. Okay, now if I take your feedback, mainly the answer to this question is like overall, is it like more of a calculation or is it like more of an explanation? I'm just taking your views. So that we can decide whether we have to put our main answer in the word processor or in the spreadsheet. So correct, it is explanation with some calculations, that's what I agree. But the main component is explanation or calculation. So if I look into this 20-mark question, here I can see a complete explanation. Here I can see a complete explanation. So 8 plus 5 like 13 marks are for complete explanation. Calculate with brief explanation. So here calculation with brief explanation. So mainly if I look into the question, mainly it revolves around the explanation. So that's why I have decided to put my main answer into the Word, although some of the parts would be covered in the spreadsheet as well, if needed be. Not necessary to use it, but if needed be. Okay. Now, let's start looking into the question. Explain whether or not a company share option scheme and a share incentive plan will satisfy a wide limited criteria for tax advantaged share incentive scheme and the income tax implication for employees of acquiring the shares in each case. I'm going to start part A of the requirement, which is like company share option scheme. Now, if I look into the scenario, employees will be selected to join the scheme dependent on their period of employment with the company. So it is like selection of employees. In CSOP, the name of the company is Vicon Limited, is free to select employee as per its wish to participate in the scheme. Selection of employees, then the second criteria was each employee will be offered options to purchase worth 3,000 each year. Then the second discussion would be like value of options granted. Now, what was the value at grant date? What is the maximum number of value of options which can be granted? The maximum value of shares which can be granted is like 30,000. So I am using the like Vicon Limited. There is no annual limit there is no annual maximum limit, but an employee can only be granted options over CSOP up to a total value of 30,000. After the value discussion, employees will exercise their share options after 5 years being granted. So I'm writing holding period. The minimum holding period is 3 years with maximum period of 10 years. With maximum period of 10 years. Vesting period of 5 years would not have any tax implications. Then the second discussion is about share incentive plan. By the way, at times some of the students ask me a question, sir, in exams can we use the abbreviation or not? So to this question, yes, you can use the abbreviations. Like if the abbreviation is a standard, for example, for personal allowance, the use of PA is a standard. For annual exemption, A/E use is a standard. So the standard is fine, but for example, if it is a non-standard abbreviation, you can use it, but you have to specify at least once in the question. So if I look into the question, has examiner used the word CSOP, SIP? If the answer is yes, you can use it directly. Otherwise, like it is strongly recommended to use the abbreviation once in the answer, like I did, and then you can use the abbreviation. Okay, so okay, uh, if the scheme is a SIP, selection of employees, selection of employees, all employees must be offered to participate in the plan. Then value of options granted, value of options granted, Y Limited can give each employee free shares up to the value of 3,600 each tax year. Since Y Limited is offering shares worth 3,000 per year, it would be acceptable. The last condition is about holding period and the tax implications. Employees will remove the shares after 5 years from the plan after 5 years. There will be no income tax. In the requirement, am I supposed to address the capital NIC or capital gains tax? If the answer is no, then I will not talk about the NIC and capital gains tax. So I will keep my discussion restricted to the requirement, which is like towards the income tax only. There will be no income tax for employees when free shares are removed from plan after 5 years. Any question in particular relating to this? No? Okay. Let's start the part B of the requirement. No, so you are not supposed to consider all of the conditions. Just keep your discussion specific, like just to answer your question. I've not discussed any condition relating to the uh, free matching shares, partnership shares, because there was no discussion around it. I only keep my discussion around the relevant stuff. And like I said, I not discussed anything relating to the capital gains, relating to the NIC, because that was not asked to discuss. Okay, let's start the part B of the question. Calculate with brief explanations which are available to reduce the chargeable gain on the sale of his house. So I'm going to discuss second sale of the house. So I have to cover this sale of house into two broad aspects. One is with respect to private residence relief, and using the terminology which is used in the question. First thing. Second thing, please try to pick up this important theme, like how I am linking the answer to the scenario and continuously using the name of the characters, the name of the company, so that the reader would get this point, like uh, I'm not talking about in general, I'm talking about the scenario specific. Okay. With respect to principal private residence, just I'm referring to the spreadsheet over here. Okay. And I will be putting up the spreadsheet now. And giving the reference over here, working one PRR exemption. In the PRR exemption thing, now I need to look towards the scenario. Jacob purchased his house on 1st July 2013, and from 1st July 13 he moved into house on 1st January 2014. So it is like 1st July 13 to 31st December 2013. Was Deccan living into house in this period? Yes, 1st July to 31st December 13. After purchasing the property, he was not living in the property. He was not living in the property. So the 6 months would be like he was absent. So all of the months would become chargeable. Then secondly, when he moved, okay, moved into house on 1st January 14 and on his return to the UK. He was occupied the house since 1st January 14 and apart from when he was once again employed overseas. So the second period, like he was employed overseas, he was employed overseas from 1st July 15. So it means from 1st January 2014 to 30th June 2015. He was living in house. Since he was living in house, the period is 18 months. That would be exempt. Then from 1st July 2015 to 31st December 2016. The house was, he was not living in the house, but it would be considered as deemed occupy. Why it is deemed occupy? As he was employed overseas. How many months I'm talking about over here also? I'm talking about 18 months over here. Then after coming back, they can resume exclusive occupation of the house on 1st January 2017. Fine. Since 1st April 17, Deccan has led the basement. So important thing to pick up is from 1st January 17 up till 1st April 17, make it till 31st March 17. He was completely using the house for his own purpose, right? So I'm going to write it like from I will update the dates from 1st January 17 to 31st March 17, the period of 3 months, he was living in the house. And then from 1st April 17, Deccan let the basement of the house, rented himself the sale of house. So it is like till the time of sale, he was the house was let out, right? So it is from 1st April 17 to, and the house was disposed of on 31st December 21. Keep remember, last 9 months is always unconditional. So if I work back 9 months from the disposal date, this date would have been 31st March 2021. He was living in house, but 75% of the house he was living. How much is the time period? So the time period is like 48 months, if I'm not wrong. So 48 months multiplied by 75%. He was living in the house, that would be exempt, and the 48 months multiplied by 25% would become chargeable. Then the last from 1st April 21 to 31st December 21, 9 months. Now, if I make a total, now my PPR exemption would be, the gains were 145,000 multiplied by period occupied multiplied by period occupied divided by period of ownership. So the period of ownership would be like then after discussing the PPR exemption, I'm going to discuss the letting relief. The period for which the property was let out would attract letting relief, being lowest of one gain arising exemption under PPR, which is like 11941 1.76. So I'm rounding it off to, then gain attributable to the letting, and the gain attributable to the letting was gain attributable to the letting is, so I'm going to calculate it over here. Gain amount is 145,000 multiplied by the letting period is of 12 months divided by 17,059. Last, not the least, 40,000. Hence, letting relief would be 17,059. Which one formula you are asking? I just checked my comments. You are asking about this one formula, or are you asking about the something? Okay, okay. So it is gain multiplied by period occupied divided by period of ownership. For us, it is advisable to use the pound sign. So honestly, it is advisable to use the pound sign. So with respect to that, to Hamza, with respect to that, there was a condition that it should be occupied before, and the house should be actually occupied before and after, right? So with respect to the first condition, with respect to the starting 6 months, the house was not occupied uh, before like starting the meter of deemed occupied. So if he would have stayed in the house for like 1 month and then left the house, then he would get the starting 3 years PPR exemption as well. Um, I can do it in this way as well, by the way, and replace this 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 thing with the help of this. So that's your choice. That things are like examiner is fine with all of these things. Is it done? In case of yes, I like to head towards the last part of the requirement, which is about, where's my requirement? No, here is the requirements. Explain the IHT implications for Jicama gift of the apartment to Decon on 5th June 19 if Jicama were to die in December 2024. I am using the CB practice platform. Like you can see it, Test Street, ACCA Global. Part C of the requirement. Let's start part C of the requirement. The part C of the requirement basically is inheritance tax, IHT, implications of Jicama's gift. Yes, the gift of apartment on 5th June 2019 was a potentially exempt transfer, which is like PET, valued at market value at time of transfer, being the diminution in estate amount, although this PET would be gift with reservation as Jicama imposed a condition to live in the property. However, the condition was lifted on, can't recall the date, 12th March 21, when Jicama went to live with her sister. Now, the reservation was lifted before the death of Jicama, right? This would create a further PET, which would be valued at market value of 12th March 2021 if Jicama dies in December 2024. The death would be within 7 years the death would be within 7 years of PET. Taper relief would not be available as 12th March 2021 is less than 3 years old from date of Okay, I'm done with this discussion. To Collins, I guess we are looking at the same question. This is to be exact the question number 4. This is to be exact the question number 4 which I am solving. One thing I like to share with you guys with regards to this point, and I've not covered it in writing, but I'm just theoretically discussing with you. To be exact, whenever there is a gift with reservation, if you look, I have discussed like there are two PETs. One is as of 5th June 19 and second one is as of 12th March 21. Principally speaking, tax authorities would consider the PET which results in a higher tax charge and would ignore the later date. Oh, correct. My bad. Thank you. So if I look into this 12th March 21, 12th March 22, 23, 24, my bad. So I'm going to update this part. Uh, Paper, I made a mistake in counting. Paper relief would be available as 12th March 21 versus December 2024 is like 3 to 4 years at the rate 20%. Okay, so my thank you for this. So my point was like tax authorities always treat this gift with reservation in the way the thing which results in higher tax charge. So just imagine 5th June 19 versus 12th March 21. Tax authorities would consider the tax on PET which results in higher tax charge. Most of the cases, like I can say 99% of the cases, always the later date, the reservation lifting date would create a higher tax charge as compared to this. Because if I compare with respect to 5th June 19, it is like June 19, June 20, 21, 22, 23, 24. So it would be like 5 to 6 years. The paper relief would have been like 60%. So that's why we generally pick up this point like the later of date would result in a higher tax charge. The diminution in estate, to be exact, is like the reduction in the estate amount, the reduction in estate, the market value, and reduction in estate is similar, except of when there is a part disposal type of stuff, or whenever there is a transfer of quoted company shares also. Apart from these two situations, the market value is the diminution in estate. Any further question from this? So I have picked up this question because uh, it covers a large area, too much aspects. So I'm going to close it, close this one, and this one. Okay. So for sure, let's take a short 10 minutes break, then we'll resume our next discussion. So it is like 9:25 by my watch. Let's resume at 9:35, a 10 minutes break. Okay. I'm going to open up, okay, the 10 minutes break. So To Kamran, the answer is no, because it is like, sorry, it is like I'm solving an ACCA platform, and there is no option to save at ACCA platform. That is the reason. And just to share with you guys, please exit from the current exam, because our next question would be based on any other paper. I need to check it. If that's doable, that would be great. At the moment, my understanding is we cannot save it. This is my understanding. I can be wrong. Okay, so the 10 minutes remains intact, and let's resume after 10 minutes. My mic is on mute. Um, am I audible? In case of yes, let's resume the next discussion. So 10 minutes are over. Um, I repeat, am I audible? My screen is visible. Am I audible? So that we can start. We can resume basically. Okay. So the next point of discussion is one of the very important area, and this type of area is normally examined in the section A type of questions, which is like the multi-tax scenario situation. The multi-tax scenario situation is like you have to compare, you have to think of the multiple taxes in one instance, and it is like comparison of one thing over another. So it's like if we do this, what will be the consequences? And if we do that, what will be the consequences? So all that type of discussion would be covered. Okay. But since considering the time limitation, I'm not going to discuss all of that kind of issues. Rather, I'm only picking one issue to guide you people like how to address those situations. Okay. So let's start a discussion which is around uh, just to set the context is like there is a person, there is a company who wants, there is a shareholder who wants to dispose of the company. Now, he is considering either to dispose of all of the shares of the company, or the shareholder is considering to dispose of either some trade and assets within the company. And for example, I'm just saying it, uh, leave the company dormant, for example. So, what will be the tax consequences if we go with option A, let's suppose the sale of shares, or option B, the sale of trade and assets? Again, we have myself and Sarja, we have invested time in picking up such kind of questions uh, and share the relevant stuff with you guys so that it would be easier for you to be with us, and we can have a good practice. The good practice which would cover a large variety of areas. So let's start the discussion around the tax consequences in case we dispose of the shares and in case we dispose of the trade and assets of the business. The first implication, chargeable gain. The chargeable gain or capital loss would arise on the disposal of shares in the company. Ignore if SSE applies. SSE stands for, I hope you understand SSE. SSE stands for substantial shareholding exemption. Substantial shareholding exemption is available to the companies only. And if the conditions for substantial shareholding exemption are met, then whatever are the gains that would be exempt, whatever is the loss that would not be allowable. By the way, SSE is something which is like automatic. You are not supposed to claim it. It is an automatic release. As compared, if you dispose of the trade and assets of the company, chargeable gain or allowable capital loss would arise on disposal of every single chargeable asset in the business transferred to the new group company. For example, land, building, investments, but not cars, plant and machinery, which has a value and cost less than 6,000 net current assets, because all of these assets are exempt from the capital gains perspective. However, rollover relief may be available, like if you are disposing of any particular business asset and reinvest your proceeds in another business asset, you'll get the rollover relief. The taxable trading profit or allowable trading expense on disposal of intangible asset, the concept of intangible fixed assets with respect to the companies, for example, goodwill, license, franchise. However, intangible rollover relief may also be available. The implications of stamp duty. Stamp duty would be payable at the rate 0.5% by purchaser of shares. Keep remember, stamp duty land tax is payable by the purchaser, not by the seller. If we dispose of the trade and asset, then stamp duty land tax would be payable by purchaser of land and building. Number of associates. So if we dispose of the company, then what will be the implications of number of associates? The company would be leaving the group. That would be associate for whole of chargeable accounting period when leaves the group and associate with companies in new group. Decrease in number of associated companies in old group from next chargeable accounting period, because as per the concept of a company leaving the group, the company would remain part of the group for this chargeable accounting period and it would be removed from the count of associate from the next period. If you dispose of the trade and assets of the company does not leave the group. It would remain associate for whole of the chargeable accounting period. But if company sell its only trade and all of the trade, the company would become dormant. If the company would become dormant, then it would decrease in number of associated companies in old group, but from the next chargeable accounting period, not from this chargeable accounting period. The implications around degrouping charge. The degrouping charge arise if company leaving the group is in a capital gains group, received an asset via no gain, no loss transfer, and in the 6 years prior to leaving the group, still owns the asset. In such situations, if there will be a degrouping charge, what will be the consequences? The degrouping charge will be added to the sale proceeds received on the disposal of shares and increases the gain on those shares. But if SSE applies the gain on disposal of shares along with the degrouping charge would be exempt. If you dispose of the trade and assets, there will be no degrouping charge as it only arises on the sale of shares in the company, not on the sale of trade and assets. Value of assets transferred. So what will be the implications of the value of assets transferred? The assets transferred with the company at tax written down value. There will be no balancing charge or no balancing allowance would arise. Capital allowance continue to be claimed by the company on tax written down value in future. Base cost of asset for chargeable gain purpose would remain unchanged. But if you dispose of the trade and assets transferred to new group company at market value, balancing charge and balancing allowance would arise in old company. Capital allowances to be claimed by new group company on market value and base cost of asset for chargeable gain purpose would become the market value. What will be the consequences on the chargeable accounting period? If you dispose of the shares of the company, the chargeable accounting period would remain unchanged. And if you dispose of the trade and assets of the company, and if companies sell it only trade, it will cease to trade and chargeable accounting period will end. Like this point is morely linked with the concept of the company winding up. When you cease to trade, your immediately current chargeable accounting period will end, and from the next day, a new chargeable accounting period would start. The implications of VAT: no VAT arise on the sale of shares, like sale of shares is outside the scope of VAT. But if you dispose of the trade and assets, for VAT purposes, that would be considered as transfer of going consent. Transfer of going consent rules will probably apply. And if that transfer of going consent rules would apply, It would not be a taxable supply. There will be no VAT arise on the sale unless transfer land and building on which there is an option to tax has been opted. What will be the consequences from losses perspective? If company leaving the group is loss making, you have to time apportion the trading loss for chargeable accounting period. Group relief possible to old group up to the date and arrangement is in place to sell the company. Keep remember, for group losses purposes, group cease to exist when arrangement to sell the company is established. No group relief from the date arrangement to date of actual sale. Group relief possible to new group from date of change in ownership. Normal loss within the company itself available throughout. So company can adjust the loss within its own results for current year, carry back and carry forward. Unrelieved trading loss at the date of sale go with the company to the new group. Trading loss brought forward go with the company, can be used by that company in the future with itself. But watch out for the major change in nature or conduct of trade within 3 years, either side of change in ownership, because there is a change in ownership. Now, if there is any change in nature or conduct of the business, you cannot adjust the brought forward losses. Trading losses brought forward can only be used by that company in the future, cannot be group relief, because for group losses purposes, group can only like group the group losses can in the group losses group, the loss can only be adjusted for the period for which company is part of the group. So if it's like company is loss making and there are some brought forward losses with the company, they cannot be adjusted or surrendered in the group. Now, if the company dispose of its trade and assets, the company whose trade and assets are sold is loss making. Trading loss stay with the old company. That would not be transferred to the new group company because the loss belongs to the company, not to the assets. You have transferred the assets, not the company. Trading loss would have limited use. Possible claims would be current period claim against total profits before QCD, group relief to old group. Remaining loss would be useless as there will be no future profits from the same trade. If sell only trade and cease to trade, you can claim the terminal loss relief under which you can carry back for 3 years against total profits before QCD. Point to highlight, point to remember, if there is a terminal loss which belongs to a company, then it would be adjusted against total profits. Whereas if there is a terminal loss for individuals, it would be carried back and adjusted against trading income only. What are the advantages or disadvantages of selling the shares versus the sale of trade and assets? Advantages are no tax on disposal if substantial shareholding exemption applies, no balancing charge or balancing allowance would arise, loss relief goes with the company to the new group. What are the disadvantages? All of the company is transferred, all of the assets are transferred, all of the liabilities are transferred. The advantages, if you dispose of the trade and assets, the purchase can transfer just the asset the purchaser wants. So it is not necessary for the purchaser to purchase all of the assets. So purchaser can proceed with the cherry picking option. Common disadvantages, the gains would be taxable, may be deferred, but not exempt. Balancing allowance, balancing charge would arise. Loss do not go to the new group. So this is the advantage from a purchaser perspective. That was a brief discussion about the consequences of sale of shares versus the sale of trade and assets. Again, there are so many such type of comparisons. For example, one of the possible comparison could be the what will be the consequence if the person is employed or if the person is self-employed. Uh, Another comparison could be the way of doing business, either as an incorporated business or unincorporated business. The possible further discussion, the consequence could be raising the finance with the use of equity or debt finance. So, like, I'm not putting a complete list. For example, one further example which is in my mind at the moment, if I want to withdraw the funds, should I withdraw the funds if I am a shareholder, I am a director of a company and I want to withdraw the funds, should I withdraw the funds either as a company or should I withdraw the funds either as a salary or as a dividend? So both have different tax consequences. So these different tax consequences are like most commonly examined feature in the exam, and uh, you guys should have a good grip on this type of stuff. Any question relating to this? Any question relating to this, please? Whole of the syllabus is common for the exam. I was like just discussing about the multi-tax scenario type of situations at the moment. Any further question, please? Or can I move ahead to the next part? Okay, the next discussion is like just I just talked about the transfer of going concern. So let me have put some more light towards this area, which is transfer of going concern. So what will be the tax consequences if there is a transfer of going concern? These consequences at the moment I'm talking with respect to the VAT stuff. I'm not talking with respect to the any other perspective. I'm right now my discussion is towards the VAT perspective. The VAT implications of transfer of going concern. There is no VAT charge if a business or a separately viable part of it is sold as a going concern to another taxable person. So if I'm transferring my whole of the business or a separate viable part of it to another taxable person, there is no VAT charge. Such a sale is outside the scope of VAT. But there is a condition. The condition is transfer should be on a going concern basis. And how to ensure that the transfer is on a going concern basis? There are three things which can be checked. First of all, there should be no major break in operations of the business. So like just to give you an example, there can be a comma in the operations of business, but there should not be any full stop in the business. I hope you understand. Second, the buyer will majorly continue the same business as before. So there should not be any major change in nature or conduct of the business. Okay. The buyer is like would continue with the same business as it was done by the seller. If a transfer of going concern is from a VAT registered trader to a new one who is not VAT registered, then it is possible to apply to transfer the registration number of the previous owner to the new owner. It is possible, right? But keep remember, if you proceed with this option, then the buyer would become responsible for all of the goods or bads made by the seller in the VAT universe. So if, for example, seller has made any good deeds in past in the VAT universe, the reward of those good deeds would be given to the uh, purchaser today. And for example, if seller has made any sins in the VAT universe in the past, the purchaser would be answerable, responsible for for that part of the VAT. Any question from this transfer of going concern from the VAT stuff? Please do let me know. In case of no question, I will proceed towards the question part. So yes, that's only one small area of the VAT, obviously not the complete VAT. I am discussing the parts which are mainly relevant to the uh, my upcoming question. Okay, considering no further question, I am heading towards the ACCA practice platform, and I'm going to start my second question, which is practice exam question 1. I hope you guys are with me following the question, right? Right. So I'm heading towards the practice exam question 1. Okay. Are you guys with me? Okay. So I'm going to start. This is the question which I'm going to attempt now. Okay. So I hope you guys are here with me. Let's start the question. You should assume that today's date is 7 September 2021. Your manager has had a meeting with Bryce, the managing director of Grant Limited. Extracts from the email prepared by your manager following the meeting, together with a schedule of information from Bryce, are set out in the exhibits. Okay. The following exhibits available on the left hand side of the screen provide information relevant to the question. Extract from an email from your manager, schedule of information from price dated 6 September 2021. This information should be used to answer the requirements within your chosen response options. Extract from an email from your manager. Before I read the extract, I like to read the requirements. Prepare the memorandum. So there are professional marks as well. Prepare the memorandum. Okay. In the email from your manager, the following marks are available. What are the marks available? Offer A in respect of sale of company shares, 8 marks. Offer B in respect of sale of company trade and assets, 11 marks. Offer B, the VAT implications, 7 marks. Tax evasion and tax avoidance. Guys, be very clear over one thing, please. If you look into the format of the question, the memorandum is required with part A of the question, or the memorandum is required with all of the question, like for both parts of the question. Can I have the response on this point, please? No. So if I look into the requirement A, prepare a memorandum. So it is for requirement A only. So for part A, part 1, 2, 3, that should be covered in the memorandum, but part B should not be part of the memorandum, right? You know, this is the professional marks. Like if you cover part B in the memorandum as well, probably you will start losing your professional marks because you are not following the exact requirement. So take care of such a small granular things which are like sweet and simple marks, and you would be losing them. Okay. So okay, so I'm done with reading the requirement. Now let's start reading the scenario. Email from manager. Grand Limited group of companies. Grand Limited has two wholly owned subsidiaries, Kolka Limited and Sotso Limited, and also owns shares in a number of other companies. All of the group companies are UK resident trading companies which prepare accounts to 31st March each year. They prepare accounts to 31st March each year. All supplies made by the group are subject to VAT at the standard rate. So there is no exempt supply except zero rated supply. All supplies are standard rated. Sotsu Limited has been a member of Grand Limited Group for many years. So Kolka would be some situation. Sale of Kolka Limited. Grand Limited purchased the whole of the ordinary share capital of Kolka Limited for 800,000 on 1st November 2013. The value of Kolka Limited has fallen and the company is to be sold on 1st December 2021. Two separate offers have been received, offer A and offer B. So what is offer A? What is offer B? Offer A, in respect of sale of company shares, by the way, we have purchased the whole of the share capital for 800,000. The purchaser will pay 730,000 for whole of the ordinary share capital of Kolka Limited. This amount will be reduced by any tax liabilities payable by Kolka Limited arising as a result of the company being sold. Okay. Offer B. In respect of sale of company trade and assets, the purchaser will pay 695,000 for the trade and assets of Kolka Limited. Kolka Limited expected asset values on 1st December 2021. Oribi Building, 410, Actual Building, 230, items of machinery, 25, net current assets at cost, 30,000. There is further information in respect of these assets in the attached schedule from Bryce. The value of Kolka Limited goodwill is negligible and should be ignored for the purpose of this work. Fine. Please prepare a memorandum for the client file. The memorandum should cover the following. What should be the minimum coverage in the memorandum? Offer A, in respect of sale of company shares, an explanation of whether or not tax relief will be available in respect of the capital loss arising on the sale of share, an explanation of the tax implications of Kolka Limited leaving the Grand Limited Group whilst still owning the actual building. This explanation should not include any calculation. A calculation of the expected post-tax proceeds. So I can say for part A1, for the memorandum, one part, like I will be putting three headings and there will be three headings which I will be discussing. Offer B. In respect of sale of company trade and assets, a calculation of the expected post-tax proceeds. Expected post-tax proceeds. For this purpose, you should ignore any chargeable gain or allowable loss arising on the sale of machinery. In relation to the sale of items of machinery, an explanation as to whether or not they will result in chargeable gain or allowable capital loss and of the availability of rollover relief. The rollover relief which we discussed in the day one of the session. An explanation of the companies to which Kolka Limited can transfer any capital loss arising on the asset sold. Note, when calculating the post-tax proceeds in respect to the two offers, you should assume that tax relief at the rate of 19% will be obtained in respect of any allowable capital loss. So the default rate of tax for companies is 19%. So the relief, the savings, etc. would be at the rate 19%. Offer B, VAT. In respect of offer B, an explanation as to whether or not Kolka Limited should charge VAT on the sale of its building and or machinery. So whether we need to charge the VAT or not. Done with the part A. Part B. Tax evasion and tax avoidance. Bryce and his daughter, who is a tax expert in the field of capital allowances, have drawn up a plan which they claim will enable a company to claim a tax deduction of 180% of the cost of new machinery. The plan is complicated in that it involves the creation of new wholly owned subsidiary and a series of contracts involving the lease and subleasing of the machinery between the two companies. I have not looked at the plan in detail because even if it would appear to have the intended tax effect, I'm sure that it would fall in the general anti-abusive rule, the guard discussion. Please prepare notes which distinguish between tax evasion and tax avoidance and state the purpose of the guard. Explain why the guard is likely to apply in this particular plan. Schedule of information from Bryce. Kolka Limited detail of asset. Kolka Limited used both of Oribi and Actual building in its trade. Date of purchase, Oribi building, Actual building, 1st Feb 14, 1st April 19 NA. Purchase cost, 320,000 to 55,000 note 3. VAT tax Uh, VAT option to tax made? No, no, not applicable. On 1st December 13, Kolka Limited sold a machinery. On 1st December 13, Kolka Limited sold a machine for 74,000, resulting in a chargeable gain of 17,000. This gain was rolled over against the purchase of Oribi building. Fine. Need to calculate the base cost type of stuff. Kolka Limited purchased the actual building from Sotso Limited for 255,000. Its market value at that time. Okay. As Kolka Limited and Sotso Limited are both 100% subsidiaries of Grand Limited, the transfer of building took place at no gain, no loss. Sotso had purchased the actual building new and unused for 340,000 on 1st January 2018. Fine. All of the items of machinery are movable. Sale of machinery will give rise to a balancing charge of 12,100. Most of the items of machinery are worth less than their original cost. However, a number of small items are particularly specialized such that their current market value exceeds their original cost. Fine. I'm done. Now, we are clear with the requirement. Anything from the question which is not clear? Okay. So I'm going to start solving this question, but before I start solving this question, again, a judgmental thing. Majority of the question relates to calculation or theoretical area. In my view, majority is the explanation or theoretical part with a small calculation. So I would be following again the word format in default with the support from the spreadsheet. Okay, so should I start the question? Now I will be following the memorandum stuff as well. I'm going to solve part A, which is about the memorandum. The basics of memorandum. I'm supposed to write a memorandum for the client file. To the client files. Mm, client name, Grand Limited Group, subject, prepared by, and date. What should be the subject? So yeah, probably there would be a very little questions, but this question is like 40%, up to 40% in calculation as well. So I would be using a lot of a spreadsheet in this part. Yes, what should be the subject? So, am I talking about the multiple aspects, or is my discussion specific to any particular agenda? I believe my discussion is towards a particular agenda, which is like sale of Kolka Limited. So, prepared by, date, assume that today's date is, it was mentioned somewhere, I forgot. What I have to assume that today's date is? 7 September 21. You know, this is the thing which I really want you guys to learn, how to manage the four screens together. Okay, so I'm going to start part one. Part one is around offer A, which is in respect of sale of the company's shares. With respect to the sale of company shares, the detailed requirements were explanation of whether or not tax relief will be available in respect of the capital loss arising on the sale of shares. Tax reliefs, tax relief available in respect of the capital loss on the sale of shares. Yes, tax relief available on the sale of shares. Mm, the capital loss of 70,000 on sale of shares will not be allowable for tax purposes due to automatic application of substantial shareholding exemption. SSC would apply because Kolka Limited is a trading company Grant Limited owns more than 10% of the share capital of Kolka Limited for at least 12 months in the last 72 months prior to the sale of company. So I'm thinking to put these 2 points at least in bullet. That looks good. So first of all, I discussed with respect to the substantial shareholding exemption, whether the substantial shareholding exemption would be available or not. Done. After the discussion about substantial shareholding exemption, the second part was explanation of implication of leaving the Grand Limited Group while still owning the actual building. This explanation should not include any calculation. So the tax implications of Kolka Limited leaving the Grand Limited Group whilst still owning the actual building. So what will be the consequences if the company is leaving the group, still owns the asset? So what will be the consequences? First of all, the degrouping charge would arise. I'm not writing it to be exact, I'm just guiding you. Write in general the conditions of degrouping charge, then link the conditions with the scenario. Like if someone asked me how you can link, how you can guide, like if I were to write, how would I would have write. So for example, I would first guide the general conditions of degrouping chart. Uh, if asset is transferred within the capital gains group and the company is leaving the capital gains group within 6 years of assets transfer and still owns the asset, then there will be a concept of degrouping charge. First, I discussed in general, then the scenario specific. Since Swatso and Kolka Limited were in capital gains group, hence the transfer of actual building would have been at no gain, no loss. Uh, since Kolka Limited is leaving the Grand Limited group within 6 years of purchasing the building from actual building from S Limited, and still owns the asset while leaving the company, and there will be a degrouping charge. The degrouping charge, that's it. So am I supposed to calculate? Okay, the degrouping charge is calculated based on the philosophy that if the asset would have been sold at market value at time of transfer, rather than no gain, no loss transfer, the amount of gain is called as degrouping charge. So this is the thing which I have to discuss. The degrouping charge would be added in the disposal proceed of the shares, and it would be exempt due to availability of substantial shareholding exemption, because for part A of the requirement, we discussed that it would qualify for the substantial shareholding exemption. Uh, is there any question in this part of the requirement? Uh, okay, one more discussion. So first discussion was about the degrouping charge. Second discussion would be around stamp duty land tax, which is like SDLT. SDLT is applicable on the sale of shares. Sorry, SDLT, stamp duty land tax, is applicable on the sale of building. Since the asset was transferred at no gain, no loss within the capital gains group companies, hence at time of transfer, there will be no stamp duty land tax applicable. However, Kolka Limited is leaving the Grand Limited group within 3 years of purchasing the building. Hence, the exempted SDLT would claw back and become taxable, become chargeable. So first, I need to discuss the exemption of SDLT at time of transfer of asset between capital gains group companies. In the second step, I will discuss the clawback of the SDLT exemption as Kolka is leaving within 3 years of transfer. Is this part clear? Post-tax proceeds. For post-tax proceeds, I would be referring to the, for post-tax proceeds, I would be referring to the working one. post-tax proceeds. Now, if I were to think about the post-tax proceeds, the sale proceeds were 730,000. Then SDLT payable would be the post-tax proceeds. SDLT payable. So I'm looking towards the exam rates and tables, and we'll be looking for the stamp duty and tax rates up to 150,000 0%, 150 to 250 2%, 250 and above 5%. So it is like 150,000 0%, 250,000 minus 150,000 at 2%, and 255,000 was the market value, minus at 5%. Stamp duty and tax payable is by the amount 2250. As a result, the post-tax proceeds would amount. Moses, this understanding is correct. The exam rates would be provided, exact tax tables would be provided in the exam, and that is always available. Anything to ask from this part, or can I move ahead? Thank you, exam rates. Now, let's look towards the part B. Offer B. So that was offer A. To offer B is in respect of, sorry, sale of the company's trade and assets. Did I put A over there, or did I put 1 over there? Let me check. 1. The formatting. Uh, a calculation of expected post-tax proceeds. For this purpose, you should ignore any chargeable gain, allowable loss arising on the sale of item of machinery. So straight away, it's a calculation. So let me first calculate. Since in both the workings I am calculating post-tax proceeds, so I am updating it. Post-tax proceeds on sale of shares, post-tax proceeds on sale of trade and assets. The total sale proceeds were the total sale proceeds were 695. What I need to calculate a calculation of expected post-tax proceeds. So this is my proceeds. I need to pay any kind or sort of tax on it, and whatever is the differential, that would be post-tax proceeds, right? So total sale proceeds, I would be deducting the tax charge or credit. I would be calculating the tax charge or credit for OEB building, plant and machinery, Athule building. And the sum would be my post tax proceeds. Now, for this thing, OEB building. OEB building had a market value of 410. Thank you. For OEB building, market value was 410. The cost of OEB building was the cost of OEB building would be 320,000 minus deferred gain of 17,000 to arrive at the base cost. And since cost should be deducted, so I'm putting a negative sign. Indexation allowance. Indexation allowance, the OEB building was purchased on 1st Feb 14. 1st Feb 14, okay. Um, 1st Feb 14 to Feb 14 to December 17, 0.094, 0.094 as a result, chargeable gain would amount So on OAB building, the after tax proceeds would be, the charge would be after OAB building, the next would be uh, actual building. For actual building, the proceeds were 230. Proceeds were less cost. And since this asset was transferred by uh, S Limited. So I would be taking the cost to S Limited because I understand that transfer of asset would be at no gain, no loss. Point number one. Point number two, since the building was purchased after 31st December 17, hence there will be no indexation allowance as well. So I would be putting this point in my comments, like as a result, I get the allowable loss by the amount 110. So this would behave like a credit to this. The two notes are important for me. No indexation as building is purchased after 31st December 2017. No indexation allowance, and cost to uh, so limited would be cost to Kolka Limited as transfer of asset between capital gains group is at no gain, no loss. Uh, at the end, the discussion of machinery. So if I look into machinery, all of the items, the sale of machine will give rise to a balancing charge. Balancing charge means have to pay tax on it. So there will be a tax charge on it. Again, I'm calculating after tax proceeds. So that's why to calculate the after tax proceeds, the things, the stuff, wherever there will be a balancing charge, sorry, there will be a tax, I have put it in negative, and wherever there will be a relief, I have put it in positive. How did you arrive at the value of 250 for the SDLT? Oh, sorry, I missed that. So it is 5,000 into 5%. How I arrive at 5,255, the value of building minus the amounts covered by 0% and 2%. So there is no Bible rule that you cannot write any statement in the spreadsheet. I have mentioned these points in the spreadsheet because these are directly ones which supports my calculation. So that's why I put it in my calculations in the spreadsheet. I always use check out the main objective. So I hope SDLT clear, the spreadsheet point clear. Now coming back to the email from manager. Uh, okay. In relation to sale of items of machinery, an explanation as to whether or not they will result in chargeable gain or allowable loss and any of the available relief. Now, my discussion would move around uh, chargeable gain or allowable loss, allowable capital loss, on the sale of machinery. Yes, chargeable gain or chargeable loss. So, the bullet points which should be discussed over here. First, the chattels stuff, chattels part, tangible, movable, life less than 50 years, wasting, exempt. Then wasting chattel parts. Then second point of discussion should be low value non-wasting chattels. Low value as in like which has a disposal proceed cost less than 6,000. The next discussion, the plant and machinery on which capital allowance will be claimed. Ignore capital gains or loss as it would be covered via capital allowances. Then the plant and machinery sold at profit would not fine. So this is the three key aspects which I would be discussing with respect to the item of plant and machinery. The third part, explanation of companies to which Kolka Limited can transfer any capital loss arising on the sale of assets sold. So my third point would be transfer of capital loss to group companies. First, discuss the principles, not principles, the definition of capital gains group. Once you are done with the discussion of the capital gains group, then like discuss the definition of capital gains group, identify the gains group companies in it. Okay, so discuss the implication of transfer of capital loss. Like I do remember yesterday, till I recall, we had a discussion around the capital gains group where direct shareholding more than 75, indirect more than 50, uh, implications is for UK resident company. If meets the definition, the capital gain or loss can be transferred, but do not use the word transfer of capital loss over here because here we are mainly addressing the loss aspect only. So don't feel the examiner like you are answering in general. Rather, you should be specific. And how to be specific? Like talk about the transfer of loss only, and it can be transferred to company, for example, to Grand Limited, to S Limited against their capital gains. Uh, Transfer of capital loss to the group. And after this, like I'm done with this. So the third point is offer B VAT. With respect to VAT, in respect of to Moses, the answer is no, because capital losses and gains are not part of the group losses group. They are part of the capital gains group. So do not talk about the group losses group or consortium over here. So, in respect of offer B, explanation whether or not Kolka Limited should charge VAT on the sale of its building and or machinery. So first of all, you will discuss about transfer of going concern. So that discussion mainly revolves around transfer of going concern. So you have to mark the conditions to qualify for TOGC, transfer of going concern, and if transfer of going concern conditions are met, outside the scope of VAT, no VAT would be charged. And do talk about the land and building implications at time of transfer of going concern. So these are the three very broad dimensions which should be addressed, which should be considered while addressing this part of the requirement. Considering the time limitation, I'm not writing too much. Rather, my main focus is on guidance. By the way, I'm done with, for example, I'm done with part 3, means I'm done with the part A of the overall question. I'm done with part A of the overall question. Hence, now I will be referring towards the part B. And just to give you a, like, here my memorandum ends. Here my memorandum ends. So part B was tax evasion and tax avoidance. Like I advised you guys yesterday, doing the same today, keep the pattern of formatting same. So since I have marked requirement A with bold and underline, so keeping B requirement in the same way. Tax evasion, tax avoidance. So yesterday we had a discussion about the tax evasion, tax avoidance, the use of GAR, General Anti-Abusive Rule, uh, which is like strictly not allowed kind of discussion. So under this paragraph, just to give you a reference, first discuss the basics of tax avoidance and evasion. Uh, Basic themes. Avoidance means using legal ways to reduce the tax. Evasion means using unlawful ways to reduce the tax. The evasion could lead to criminal offense. It could lead to money laundering. Avoidance is not is lawful, but now with respect to but, link avoidance with GAR. Like if you start creating a series of transactions to avoid the tax, then such things would fall under the general anti-abusive. And if it is under the general anti-abusive, uh, there can be a tax penalty as well. So one of the evidence of that it could fall under the GAR, you are creating a subsidiary, you are creating a series of transaction, you are creating a series of contracts which involve leasing and subleasing. So due to all of these stuff, it would likely to fall under the GAR, and there will be additional tax charge to the uh, Bryce and his daughter. So these are the lines of the discussion which should be made as part of this part B. Uh, Taking a relaxing breath, looking for your questions, if any. Yes, so the questions from your side, if any. Oh, so let me try to print this. I can print this. Sure. So I have saved it in PDF. So I will share this PDF with you. with all of you guys, in fact. And anything in particular? I'm going to close this. In the meanwhile, I'm closing. I'm looking still towards your questions. Uh, yes, that's correct. Like these are this kind of situation at times bit tricky in the exam to think about, but if you have a good practice of such situations, that would not be as such difficult. So again, the condition, a good practice. Otherwise, no. In exam, what processor will auto save the text? Uh, to Junaid, the answer is yes. The word and the spreadsheet. So it's like in front of you. I have not pressed the save key, but if I go to question one and open up this one, not this one, sorry, the word processor, my answer is there. If I open up the spreadsheet, my workings would be there, although I didn't press any kind of save thing. So all of the stuff would be there. The only thing which would not be marked is if you are using anything in this workspace. So no workspace, no workspace, sorry. So no questions further. Okay. So in case of no question, I am good to. It appears that in some cases the question does not highlight the requirements and we have to consider the answer based on our understanding. Moses, like that would be very rare. So at times, if I look into this question, the good part of the ATX syllabus, the exam format is, if I look into the requirement, that is very generic. I cannot understand what is the exact requirement from here. But normally within the question, the detailed requirement is there. And if it's like a very different kind of situation, at times examiner guides this thing as well, how to attempt the question. Like if it's very generic, like you are saying, examiner at times guide this thing as well, how to approach the answer. I can give you good examples of such situations. Okay, so thank you very much for today. Apologies for being late, but the questions takes time normally. So from my side, that's it. Tomorrow and the day after tomorrow, like day 3 and day 4, Sir Zia would be joining you guys. Both of us are available at WhatsApp, so you guys can raise your questions, if any, over the WhatsApp group. We try our best to respond to your queries in the first availability. So thank you very much. Good night. I don't know whether should I say this or not, but happy 14th Feb. Happy Valentine's Day. Bye bye.